Olá pessoal, um dia muito feliz aqui para mim. Eu como grande fã da Oaktree, não é jabá e nem é papinho, leitor, tento implementar as ideias brilhantes do Howard Marks. Estou hoje com Wayne Dahl, chefe de risco da Oaktree, e com o Bernardo da Itajubá, que tem uma ligação muito próxima e íntima com a Oaktree. Muito obrigado, bom dia. Vou falar inglês, aqui meu péssimo inglês, mas em respeito aqui ao Wayne, e depois aí a gente tenta entender esse inglês macarrônico que vai rolar, mas acho que a gente vai conseguir fazer. Bom, Wayne, thank you very much for being here. We are huge fans of your work, huge fans of Oaktree, of Howard, and so I'm very happy to have you here. Thank you very much. Bernardo, muito obrigado. Thank you.
It's a pleasure.
I would like to start talking about the main risks, or at least things that people say there are the main risks at the markets right now. So the coronavirus, for example, how worried are you? How big is this risk for the economy and for the markets, in your opinion?
Yeah, well, first of all, thank you for having us here and being supportive of Oaktree and what we're trying to do. To your question first, the coronavirus, it's definitely new in the markets today, and I think it's probably impossible to really know today what that impact will be on investing. It's certainly something that investors are going to pay attention to when you have the second largest economy in the world that will most likely slow down in this quarter. That will have an impact. The supply chains for numerous products come through China, and so anytime you disrupt that, you can have issues and you can have problems. But at this point, we just don't know how long that will last and how quick that recovery will be. But it's certainly something that we're aware of and conscious of in our investing today.
In practice, did Oaktree react? Doing something, became less aggressive or more aggressive when the market went down?
One of the investment philosophies at Oaktree is that we try and avoid timing the markets. Mm-hmm. This is something that Howard and Bruce Karsh, our co-founders, feel strongly about. So it is something that we talk about and we look for how that can influence different names in our portfolio. But we don't immediately come in and make a dramatic shift in the portfolio as a result. We don't want to try and be that market timer who may get it right and may get it wrong. If we believe in the fundamentals of the companies that we're investing in, then those should sustain through some of these market volatile events.
So you haven't changed since anything basically?
Since the announcement of the coronavirus, no, we haven't made dramatic changes, but again, it's something that we certainly follow and try and understand, and it certainly could influence a decision down the road.
Okay. And talking about another risk factor here, the U.S. elections may be the biggest event of the year. Do you have any opinion on that? How do you measure or try to measure, or if you don't even try to measure, the impact of this kind of thing?
Yeah, no, that's a great question, and you're right. It is certainly something that I think people around the world will be following for the next several months. One of the things at Oaktree, again, hearkening back to our investment philosophy, is that there's really a disavowal of macro forecasting. So we're not going to be the company that's out there making predictions of who will win the election and how that may influence the markets. But as we look at the markets and try and gain understanding, I think it's clear that financial markets today expect President Trump to probably win a second term. But that doesn't mean there aren't risks out there. We're just getting into the period where the Democratic candidates will be chosen. Certain candidates, I think the market will view more favorable than others. So as that dynamic plays out, we could see some influence there. But overall, when you have an incumbent president, he wants the economy to do well. They tend to get reelected when the economy is doing well. So I think President Trump for the next several months will try and do kind of all he can to keep the economy in the U.S. moving forward.
Bernardo, I would like to hear from you also, because you're very close to Oaktree, but you talk to a lot of people with
Yes.
high net worth and other big investor guys abroad. So do you have any opinion on what you're hearing about these people on the US election?
Yeah, I think it's everybody is looking very carefully on that, you know. But as Wayne said, you know, you need to look the fundamentals and look, you know, the what is going on in terms of the company, in terms of the stocks and etc. But I think it's yes, we have a really concern regarding that. Have the populism, you know, taking care in both sides. But you have for sure we'll have a volatile market for looking ahead.
And those guys that you talk to, they're more aggressive, more
conservative.
Conservative,
for sure. Wayne, that's one question. You know, how Howard it's looking for this environment and how it's thinking in a way to, you know, conservative, more aggressive, more carefully. You know, how you are, the mindset of Oaktree nowadays.
Yeah, and you know, that's a great point, Bernardo. And if you've read any of Howard's memos or heard any of his interviews, you know, the election is another reason, I think, that he's adopted the mantra of move forward, but with caution. Mm-hmm. So it doesn't mean that, you know, you take all investments and risk off the table, but as Bernardo said, you have to focus on fundamentals and, you know, making investments that can sustain any period of volatility.
And it seems to be a very difficult environment, because it seems that things are expensive, but they keep going up. So it's difficult, at least for me, when I look at the market and think, oh, this is expensive, and the other day it's more expensive, so it doesn't stop.
Yeah, you're right. I mean, and that is one of the reasons why, you know, Howard has adopted that mantra of moving forward, but with caution. And it's certainly one of the signs that, you know, he would say, and if you read in his latest book about market cycles, is the ease in which, you know, companies, both quality and low quality, can access credit markets, and as you said, keep consistently, you know, defying what we would think is their highest limit. So, you know, we look for fundamentals. One of the things that we try and do at Oaktree is make sure that we're achieving returns commensurate with the risk that we're taking. And sometimes that may mean that you'll have to accept lower returns because the risk isn't aligned with that return you can get. So that's been our philosophy. That's what we've tried to do and will do for the foreseeable future.
And since you talked about the cycle, when you look at the U.S. economy, you see the longest expansion ever. And are you worried about this phase of the cycle? Do you see something imminent that could change, or what's your opinion?
Yeah, that is a great observation, and it gets a lot of press. Certainly the length of the economic cycle. We're now more than 10 years into that recovery. And, you know, one of the things that is probably concerning, although I'm not sure what will trigger it, but the incredible growth in debt that we've seen, whether it's issued by sovereigns, by governments, whether it's issued by companies. You know, there just seems to be an excessive amount of debt, while you have central banks around the world that seem very supportive of continuing that issuance of debt. Low rates globally. I mean, last year we saw several central banks cutting interest rates. You know, normally, and if you've read not Howard's most recent memo, but the one before that, he talks about these negative interest rates and central banks, how they've gone in and essentially tried to stop the economic cycle. And it's strange that we see this persistent behavior, but you know, what will trigger it, I'm not exactly sure, but certainly seems like they're geared towards, you know, keeping these low rates, keeping money flowing, and keeping the cycle extended.
Anything you'd like to say?
No, it's how to implement, you know, looking for the global market, the global credit market, how you are implementing, you know, in a ways how you are being so selective in terms of issues. What is the main things that you are in your role of controlling risk, diversification? How is your view on that?
Yeah, no, that is very important today. And you know, if I could point another one of the you know, Oaktree's investment philosophies, the number one is the primacy of risk control. And what that means is, again, you know, achieving, you know, risk-controlled returns with the ultimate focus on preventing loss. And that's, you know, what we strive to do in looking at the whole global credit landscape is where do we see the least amount of excess? Where do we see investments that have appropriate risk that, you know, can be purchased with a low probability of loss? And that's what you strive to do in these kind of markets until, you know, you find a more obvious dislocation that you can turn to.
And some people are talking about the new phase of monetary policy coordinating with fiscal policy, and then now some people say that the governments are gonna, the central banks were very supportive, as you said,
yep.
And now the government, the treasuries are gonna put more money in the economy, and then this would stop a recession or maybe even start a new cycle or turn it even longer. Do you think this third phase of monetary policy with the fiscal, do you have something to say about this, what they are calling the coordination between central banks and treasuries?
Yeah, no, you definitely saw that in the United States at the end of 2017 when President Trump implemented his tax cuts. You know, that was a significant fiscal stimulus. I mean, it added almost $1 trillion to the debt in the United States, but it did serve to boost the growth rate to almost 3% for 2018. I think the one risk is that, you know, some of these things can be temporary and their effects can wear off, but the debt can last a long time. So I think that's the question that people need to ask or understand is, do we want to continue to see very short-term wins, but a potential longer-term loss? I mean, any of those fiscal stimulus measures are going to potentially borrow from the future. Mm-hmm. And that's the risk that you have to keep your eye on is when are we going to have to pay for that borrowing and when is that going to be observed in investments and in financial markets?
And do you think the negative interest rates are a problem, or it's just something that could be 0, could be 1, and could be -2, or?
I think, again, it's probably hard to really understand the true impact. I mean, it seems like a very strange concept. The other, you know, issue with negative interest rates is it's troubling on financial sectors, banking sectors, and also it feels like it's difficult for countries that have engaged in negative interest rates to eventually come out of that environment. So I don't think we fully, just like we don't fully understand the kind of growth in central bank balance sheets, I don't think we, again, fully understand what that impact is going to have on the long-term growth prospects. You know, is Europe content with growing at less than 1% for the next several years? You know, I'm not sure, but that kind of feels like the path.
And something that interests me a lot, like how do you measure risk? Because the financial market, it's so volatility is the same as risk, and Empiricus comes from Empirica, from Nassim Taleb, our company, the name of Empiricus. So we are always very worried about the thinking volatility as the same as risk, and our always worry about black swans and other things that you cannot measure. It's very easy to measure standard deviation, but it's difficult to measure kurtosis. So how do you measure risk, or if the measures of risk that you have on Oaktree?
Yeah, I mean, first of all, you know, risk for us, and the most important risk is the risk of loss. And that's something that, you know, again, we strive to avoid. And again, as I mentioned before, it's our number one investment philosophy, and that's something that, you're right, is difficult to measure in a single, maybe quantitative number, which is why there's really no substitute, especially in credit investing, for the actual bottom-up fundamental credit work, and coordinating that with views on the broader markets and how those macro events can influence your investments. Risk. I think one of the kind of other misunderstood areas of risk, or not maybe misunderstood but underappreciated at times, is liquidity. If I buy an investment, am I able to get out of that investment? How are my assets aligned with my liabilities? Those are risks that tend to accentuate areas in the market. Am I using leverage that I may not be able to pay for in the future? Those are the kind of important measurable risks, I think, that we need to always have in mind. And if you're aligned with those, you should be able to withstand, as you said, that black swan event that nobody can see coming and the market doesn't anticipate. You want to be prepared and have sound fundamentals backing a portfolio that will withstand those events.
And what is your biggest worriness nowadays? What do you think? We wake up in the morning and say, "Oh, this frightens me," or?
I think one of the biggest risks in the market today is just the excessive amount of debt, as we mentioned before. You've seen companies of all different kinds and shapes and sizes and industries have very free access to the capital markets. And what will happen when things turn and when things change, and what will be that trigger event? As you said, it's very difficult now to kind of see that one single event, and it's easy to basically adopt the mentality that, well, it can continue, and it can continue because central banks are supportive, and they probably will continue to be, but it's, when will that mindset turn? And I think you've heard people in English would say it's pushing on a string, meaning there's, it doesn't take much to alter the current landscape. And my concern is when will that event hit? What will that be? And will we have the liquidity? Will we have the assets? Does the fundamental work that we've done allow us to get through that event?
And for us to close our conversation, the majority of the people who are watching this, they are retail investors, and I'd like to use your experience, if you don't mind, and to tell them something that they should learn, or they should worry about measuring risk, or measuring the risk of their portfolios. What could you tell them?
Yeah, no, it's a great question. I think all investors, both as professional investors or retail investors, we need to be asking ourselves those questions. One of the things that we hear a lot in this market, there are kind of two expressions that we hear in the United States, which are, the first is, there is no alternative, meaning you're forced to invest in the market because interest rates are low and you have to seek risk. And the other expression is the fear of missing out. Mm-hmm. So you're cautious, you stay on the sidelines, you take less risk, but the market keeps going up, so you eventually concede and follow into the market. I think both of those, which are at risk for investors, are that it will force people into the market, which you could almost say they're going to potentially buy high and sell low. And that's the exact opposite of what you want to do. And so at times when risk is high or higher today, you're buying. When markets drop and value is greater, people look at the losses and will sell regardless of the kind of change in fundamentals, even though in some measurable ways the risk is actually lower. So, sticking to your kind of core beliefs, not getting sucked into these, fear of missing out, momentum, and, staying true to your philosophy with a diversified portfolio.
Thank you very much. And Bernardo, I would like to hear from you also. They would like to hear from you.
No, I think it's what Wayne said. It's great. You know, we are seeing in Brazil a lot of people. You have the lowest interest rate for a long period in Brazil, and the people are pushing to take risk and more risk. I think the diversification, not only in Brazil, but looking globally, my view, it's key. You know, sure. For sure you have better portfolios. You know, diversification, not only in Brazil, looking abroad. That's my key message.
Thank you very much. Thank you very much again. It was a huge pleasure for me. This is your house. Come back anytime you want.
Thank you very much.
Pleasure.
Bernardo, thank you again.